Good evening. Ira Epstein, and I'm back, and I hope you're back. This is Thursday, the 26th of December, 2024. The time right now, we're getting on right now to 6:05 p.m. Central Time. And let me take this moment to wish you and your family Merry Christmas, Happy Hanukkah, and now we're back to trade. I'll be here through the new year, so not going away. I just missed this morning, but I knew I would. I alerted everybody that that was going to be the case and drove back today from where we were and ready to go. All right. So it's an interesting market. In the stock market, I noticed today that when I was doing my SPDR ETF work, that I had lost bearish embedded readings on one of the most amount over the past 3-4 days that has happened, probably in the year. So the question is, what does that mean? Will it do what I think, give you the pop into January 2nd? I think it will. I think you're setting it up as you lose this bearish momentum in the market. Does the market have to run far? It doesn't. That's not what it's about. It's about the market not dropping, and over this 26th to January 2nd period, the market generally advances. Now, traders will be looking to see how much it advances, if it advances. Number two, if it doesn't advance, what does that mean? Is that a harbinger for the year, for the month of January as well? That's what traders will look for. So you're going to hear a lot of talk if you watch financial TV just on that particular subject. I, of course, don't believe that any one period makes it work. It's like saying in the old days, remember, if the AFL or the NFL won, here's what the market would do basis that. All right, so these things you try to figure out, but there's some statistics behind it, and that's what traders bank on. In terms of news tomorrow, it's all about energy. Tomorrow you're going to get the EIA reports on both natural gas and the stockpiles of crude, distillates, and gasoline. So you're going to get all that tomorrow. You want to pay attention, see what it does. Energy prices are very, very stable. Bonds and notes, well, you fell a little bit. I think the 10-year note was 4.58 today, if I read it right. I wasn't around to look at everything, but now I'm back. So I pay attention to that. In the currency markets, the question is, can the dollar pick up and run right here? So let's take a look and see where we're at. First off, you can deny whatever you want. The market fell back, held the 18-day average of closes. That's so often what I teach. And by the way, I'm having my big sale right now on my courses. So if you're looking to learn, we'll come back to this in a little bit. But here's my course sale. I'll explain how this all works. This is my New Year charting course sale, and it's only for a short while. It's the biggest discounts I've ever offered and the most product I've ever offered for that. You buy one course, you get to choose another at your gift to somebody, yourself, whatever you want to do. You'll see what I'm saying in a moment here. So stay tuned after this. All right. So in the E-mini S&P 500 index, you fell back, hit that 18-day average, and you're knocking on the door trying to come up on a closing basis for a new high. You're not quite there, but you're knocking on that door. You can see how the market has come back up and where you're at this point in time on a daily bar chart. That was a weekly that we were looking at. You can see that the market's not in a downtrend anymore. This big move up was the washout day. We talked about that, and you have carried up. The market is fighting, and look where it stalled. Remember, as we were coming up, I said the market will probably go to the 18-day average, and that's where the battle will be to see, can it bust through there and go? So a lot of traders look at today's close. Now, let me back up just a day here for you. And when they look at today's close, how the Santa Claus rally works traditionally is the market moves up from the 26th, traditionally, to January 2nd, traditionally. It doesn't work every year. I think if you go back 50 years, you're going to find it's about 78% of the time it has worked. The average gain has been about 1.3%. Not a lot, but if you add 1.3%, let's take 1% of 6,100 is 61 more points. It certainly takes you back up into this area. That's the point that I'm making. Will the market be able to make that and get up to that area, or is it going to peter out? Right now, you're just fighting tonight right at this zone. The market held the Bollinger Bands. It also made a spike towards that 100-day average. That lasted about an hour or two, and it came roaring right back in the marketplace. And you can see you're already into an area that's getting overbought. Any reading over 70 is overbought. You're 69.89. So it's a rough area right now in the market. I never said it was going to be easy. The NASDAQ is also over the 18-day average. It too made a challenge of the Bollinger Band, snapped right back. If you look at this market, the resistance back at the upper Bollinger Band. If we step in and look at the Dow and the Russell are the two weakest. The Dow has been fighting a battle at the 18-day average. We'll see if the market can snap up from here. I would look for the 18-day average to be your fighting battle in the market. Is that all it's going to offer? Don't know. In the Russell, this has been weak just like the Dow. So it tried to stay under the 100-day average and the Bollinger Band. That didn't work. So the market's coming up. I can make the argument for short covering, but I'm certainly not making an argument that you're going to get back up here by year end. If it does it, terrific. I don't see why it would. 4.58% 10-year rates are an enemy to Russell stocks. Not a friend, an enemy. Often the Russell stocks are companies that aren't the big profit companies. There's a few in there, don't get me wrong, but it's generally not. If you take a look at how many were profitable for the year and so on, you'll understand what I'm getting at. The second part is they're generally smaller companies that rely on financing. And if they have to get that financing and they're paying 4.5%, near 5% interest rates, that's not a friend to them. When you take a look at the 10-year notes, you can see today had an outside day to the upside, but it is a bearish embedded reading. So I think traders will look to see if there's any follow-through, and they'll probably sell into it. If the red line closes over 21, they'll back out of the shorts. That's what I'm expecting to happen. The same thing is happening in the 5-year notes. The story was you made the lower low, came back. So I'm looking at these markets that if they had good rallies, I think the pros might sell them on those rallies and come out if the market loses that bearish embedded reading. In the dollar index, you're embedded. So now I'm looking for the trade to be a buyer in this market on this pullback, still looking for the market to go up, maybe even a new contract high against the 108.44 level right now, which is the upper Bollinger Band. And in the euro, you're too oversold. You have the market with a pattern here that has got the trend is up, because you got higher lows, higher highs, but the bias is down since you're under the 18-day average. That's how I define bias. So it's a bear market rally at best. Doesn't mean it's going anywhere to the upside of any importance. I'm still in the bear camp in the British pound. I'm expecting them to do more interest rate cuts this coming year. 2 to 3 is what I've got marked down from everything I'm reading. I can see how the market is oversold. I'm not advocating you go short in an oversold market, but I'm certainly advocating waiting to get short. In Bitcoin, as I look at the market, higher high, lower low, you can see this whole area here. Once you made that 110 level for all purposes, 108 to be specific, the market fell back pretty hard, back to the 92,000 level, and it's getting itself oversold. So I see a market void of a trend right there. When we look at the energy markets, you've got markets with lower highs, lower lows, but over the 18-day average. So as I call it, the trend on the swing line is down, but the bias is up. That negates, for me at least, trying for you to do anything. The resistance seems to be the 100-day average to the Bollinger Band, and the support seems to be the 18-day average of closes. When you look at the WTI, it's a similar picture, no real change there. You can see that in heating oil down. And today they pulled the plug on the natural gas. They just let this market really go into a state of collapse today. You come back from the holiday, and you could see the market was down today 5.28%, not getting that much of a bounce tonight. And it looks to me like the market's formed a trading top against the upper Bollinger Band. It paid little attention today to the 200-day average, and it was paying attention to it on the way up. So you're opening the door that if the market wants to follow through to the downside, look for the 100 and the 18-day average to be the potential downside target. Momentum-wise, you're overbought. I could see the market making an argument. You'd have to get over these highs and stay over them in order to convince traders that you've got something more other than a market that just let go on you. So let's take a look at what I'm going to be offering you and see if I can get this to come up. I know I can. There we go. My 2025 New Year charting course sale. So let me explain what it is. My full charting course is what I call my core charting course. It is the fundamentals of what I do. Then you add to that Bollinger Band, a separate course on it. I teach Bollinger Band basics, but not what I do in this special course, and my outside day course. An outside day appears on charts often. And how do you work with them? What does it mean? So you pick up one course and you decide what you want to do with the other. Now, what I mean by that, you decide, is very specific. You may want to give one of these courses away to somebody. Maybe you took one of them and you want to take the other. It will include, you tell us how you want to work it, 30 days to my complete futures research if you're not already taking that. It will include the Spider ETF morning video if you're not already taking it. It's going to be there. You're going to get, or whoever you give this to, my full charting platform, so that can work with it on one of the courses. Got it? The other might get the QT platform. You're going to get the Enhanced Bollinger Band course, which I sell right now for $120 on the site, or the Outside Day course. So instead of paying the $600 for all purposes, I've taken the price down to $299.95, and you get $596 back in value. You can't say it isn't a neat way to start the year off. And you take these courses when you decide. Let's assume you bought them right now and you wanted to take them 6 months from now. That's up to you. You get everything we've got. You get the charting software, the access to the mobile app that we have, everything we've got in there, the whole shoot and caboodle. And you learn because I give you the morning videos to work with. So take advantage of it. Just go to iraepstein.com. On the top left, you'll see New Year course. Again, this is the price, and you decide where you want to go from there. If you have questions, simply call my staff during daytime hours. They'll be happy to talk to you about this. I'm Ira. You take care. Thanks for watching, and I'll catch up with you in the morning.